Hi, I'm Joe Isranak, and I'll be your host for our August update. For this update, I want to focus in on the U.S. consumer. Our consumer accounts for about two-thirds of our economic output. So the health of the consumer is very important to the health of our economy and to the health of our stock market. So I want to look at, personal savings rates and kind of follow back the pre-pandemic trend. People are saving a little bit, nothing wild, but it's growing a little bit. And then things change. COVID hits, lockdowns begin. The world is shut down. People are being paid to stay at home. So they spend their money to be more comfortable while they're at home. As you see, stimmies hit, savings go up, but people quickly spend the money on electronics, furniture, big TVs, things to make them enjoy a little bit more being stuck at home. Then things begin to change again. The world begins to open back up. Lockdowns are ending. People are getting back out. They're doing things with friends. They're going to dinners, they're traveling, still spending a lot of money and staying resilient, even though there's a few headwinds in this area. But a lot of economists are calling this overspending, revenge spending, because, well, you've been stuck at home for almost 2 years, and now you get to go out and do things that you really missed doing before. But what has powered a lot of this revenge spending? A big part of it comes from what powers a lot of consumer spending, which is credit cards. And you can see credit card debt has topped out at over $1 trillion. And you can follow this trend back to the economy and things opening back up, people getting back out, revenge spending, having all of that fun. Well, with the increased debt also comes increased, servicing of the debt. And not only that, the Fed hasn't helped the poor consumer out very much, because their rapid increase in Fed funds rates have caused rapid increases of bank interest card rates. So through the majority of the pandemic, credit card rates were between 14.5%, below 15. And then boom, the Fed jumps in, rapidly increasing rates. So now credit card rates average over 20% and is actually approaching 21%. So not only now is the consumer having more debt to service, but the expense of servicing that debt has greatly increased. And so household interest expense, its rate of change has increased dramatically. Again, staying at home spending, stimmies, things are going down, getting back out, continuing to spend, revenge spending, and add that in with rate hikes. To me, this is almost crippling levels. But what does that feel like, or what does that look like to the consumer? Well, delinquencies on all credit lines have been increasing rapidly. And here's what it looks like for credit card delinquencies. The rate of change for credit card delinquencies is the highest it's ever been. So yes, the consumer is stressed, still spending somehow, but we are now hitting a little bit of wall of stress. And that's not to mention that in October, student loan repayments begin, or resume, I should say. So less discretionary income. And speaking of discretionary income, we can't forget the fact that we've had just a tremendous amount, a huge battle with inflation, which has really lowered the purchasing power of the consumer. So here is the purchasing power pre-COVID, purchasing power where we are now. And this is a 16% drop in purchasing power since COVID. 16%. So if you want to continuing enjoying the same things, doing the same things, well, now you have to spend 16% more to do that. Or if you're on a budget and you could only spend a certain amount of money, well, now you're getting 16% less in order to do that. in order to keep to your budget. So I think most of us in the industry know that a 16% decrease in purchasing power is extremely material and substantial to most people, anybody's financial plan. So yes, the consumer is under stress. Now, can the consumer continue to spend at this level through the holiday season, through the Christmas season? If they can, will they collapse on the other side of it? Now, these are questions that are unknown, but will be answered very quickly. One more point is, not only are things getting tougher on the consumer, it's also getting tougher on businesses to borrow money. So this is the number of banks tightening standards for loans. We saw a brief regional banking crisis, and this is part of that tightening up. Depositors are quickly leaving banks, going to money markets, and now causing banks to really tighten up what they're doing. They're trying to dodge another credit event. But you can see at this level, historically, this indicates a recessionary type environment. But good news, most of the economists have adjusted their opinion and saying that there's now a very low chance of a recession. But we all know how accurate our economists are. Well, thank you for a few minutes of your time. If you have any questions, thoughts, please reach out to us. We love to hear from you. And I hope everybody had a fun Labor Day weekend and maybe got to enjoy a little bit of college football.